Hi, this is David with the PlanningTemplates.com website, and I'm going to be covering for you the Planning Templates Portfolio Income Distribution tool. This is an asset allocation tool that is centered around the idea or concept that many people refer to as the bucket theory. The tool is an Excel workbook file, and I'll open that here. The workbook file has several tabs in it. You'll see down here at the bottom a cover sheet, lifestyle income sources tab, investments and benchmarks tab, bucket and allocation tab, and then a target allocation summary tab. Let's take a peek at the cover sheet. The cover sheet is in the event that you're preparing this report for someone else and you need to put some sort of a presentation cover together. Entering a name on this sheet causes it to transpose to the other sheets and become visible there. So if you do print job from this, the name of the individual the report's being prepared for will show up there as well. Has the current date, some contact information for the preparer, and then a inserted Word document at the bottom. Double click on this square and it opens up for editing and allows you to put in things like disclaimers or any other type of verbiage that might be appropriate. Okay, let's move to the Lifestyle Income Sources tab. The primary purpose of this tab is to determine what portion of an individual's annual income need will be coming from the liquid portfolio. First off, let me mention that you'll notice that the name that we entered over on the cover sheet tab has in fact flowed through to this page. In the income source worksheet at the top, we're going to enter the lifestyle net spendable income need that an individual indicates that they need in retirement. This is their net take-home pay. In this example, we use $60,000. And then we have a simple tax treatment available here, and we'll assume 15% of the gross income is going to be lost to taxes, and the model then calculates what that gross will be relative to the net that we entered. And so the model calculated $70,588. If we lose 15% of that to taxes, we'll net the $60,000 that we entered into the model. Below that section, we have fixed income sources that we'll enter. We have two cells available for Social Security. In this example, I've entered $20,000 and $18,000. Below that, two slots for pension plans. This would likely be defined benefit plans. And then there's two other cells for other. An example of what I might enter in the other would be if an individual had purchased an immediate annuity, for example. They no longer own the asset, so it's no longer part of their liquid portfolio, but they now have a contractual right to receive income, and so I would treat that like a pension plan, and I would enter that in the other cells. Then the model calculates for us what the net is, or the income that would need to come from the liquid portfolio. So we have the gross income needed less any fixed income sources equals the amount of money that will need to be made up by the liquid portfolio. To the right, I've entered the current year, and I've entered age 65 as the age point of reference. In a case where you might have a couple, there's only one age point of reference in the model, so I would key off the younger person's age in that case. And I've entered here what the current portfolio value is. And this is all sources of the liquid portfolio available to generate income. In this example, we've entered $750,000. Okay, let's move to the Investment and Benchmarks tab. And what we're going to be doing in this section is we're going to be identifying the investments that we intend to use in each of the buckets. We'll also indicate the annual return assumption that we'll use for each. Now, the return assumption is likely something that if you're a financial advisor, you'll have to get approval from your company on what is an appropriate assumption to use for the type of investment that you're listing in each of the buckets. Just a word of caution there. Bucket number one will accommodate two line items, and the data entry fields are to the left here where we would put the name of the investments. And I have cash in both cases. And we're going to put 0.1% as a return assumption for cash. We'll assume this is a money market sweep account. Bucket number 2 and bucket number 3 both accommodate 10 investment choices. I'm going to show 2 in bucket number 2 currently, and I've shown 3 down in bucket number 3. Let me just say briefly what the intent of each bucket is as far as investments are concerned. Bucket number 1 will be a cash bucket. That's money that's immediately needed, and the primary objective and goals in bucket number 1 would be stability of principal and liquidity. Bucket number 2 is intended for something that gives a better return than cash, but it's positioned to insulate it somewhat from normal market ebbs and flows while supplying a high degree of liquidity. So, and I'm sure that this particular bucket is probably the most debatable point on what types of investments are appropriate. I would tend towards, in this example at least, I'm using an equity neutralization strategy, and this is a fund that might be set up with some long equity positions coupled with a corresponding short futures position. And the basic idea is to neutralize market movement, and what's left over then would be the dividend payout of the stocks themselves. The goal of a fund like that would be to provide a bond-like return while insulating it somewhat from interest rate risk that might be typical in the bond fund environment. That said, I wouldn't hesitate to use some bonds in this bucket. In this particular case, I've listed a short-term, maybe a mid-term bond fund, or potentially an aggregate bond fund. And I'll assume for both of these earnings assumption of 3.5%, which I've already entered here. Bucket number 3, again, has 10 line items that are possible. I would lean towards a growth portfolio. I'm showing a small, simple growth portfolio of 3 line items here. I would use something that follows the S&P 500, potentially something that follows the Russell 2000, and something that follows international developed markets. And I've entered 9, 9, and 6% in this particular category as my assumptions. So that's bucket 1, 2, and 3. Okay, let's move to the buckets and allocation page. This is a fairly important page. This is what's going to cause everything to come together. There's a lot of information on this page, and so what I think I'll do first is just talk through briefly the data entry points, and then I'll come back and comment on the other information that's available here. The data entry points are the cells with the gray backgrounds, and so you can look and see which ones they are. Up in the upper left-hand corner, first off, we're going to indicate an inflation assumption. And this is an annual cost of living increase that will be applied against this annual withdrawal from the liquid portfolio. So that will be inflated through time. Over here to the right, we're going to indicate how many years of income do we want to set aside in each of the buckets. What I've entered so far is bucket 1 through, or year 1 through 1 for bucket 1, so essentially year 1. Bucket number 2 is going to be year 2 through year 8. And bucket number 3 then is 9 and forward through time. Now, let me just comment on this. The data entries that you make in this section are largely tied to the question, how long does someone believe that a market downturn or a bear market will take in order to turn around and recover? The idea behind the bucket theory is to set aside enough income in buckets number 1 and number 2 to allow bucket number 3 to go up and down with the market. It's also to allow us to have a strategy in place to provide income for X number of years in buckets 1 and 2 so that we can separate our emotions from what's going on in bucket number 3 or in the marketplace, and we can allow it to go up and down. And rather than pulling money out and sitting on the sidelines, we can leave money invested and actually participate with the next market recovery when it takes place. Okay, as we go down the page, we're going to look, we got bucket 1, bucket number 2, and then bucket number 3 down below. And what we're going to do data entry wise here is you'll see that the investments that I listed for bucket number 1 on the investment and benchmarks tab have flowed through to this page as well, and you'll see that in bucket number 2. These names here are the names I entered on the previous tab. We're going to say 100% of bucket number 1 will be invested in this first line item of cash. We're going to say that a 70-30 split will be used between this equity neutralization strategy and the bond fund that we've selected, and that could be short-term, mid-term, or aggregate bond fund likely. And I'm going to pick the 70-30 here in an effort to minimize some of the interest rate risk that the bond fund might experience in a rising interest rate environment. So I'm going 70-30 here. Down in bucket number 3, you'll see the 3 investment choices that I entered for bucket number 3 on the investment and benchmarks tab. And I'm going to enter a 50-25-25 allocation between those investments for bucket number 3. Now that's essentially a simple growth portfolio. Okay, now let's go up to the top of the page again, and let me just comment on what else is here. You'll see at the top, this is the liquid portfolio, investment portfolio that we indicated on the lifestyle income sources tab. Below that is the annual income needed from the liquid portfolio. This is the gross income less taxes and less any fixed income sources, and what's left that's going to come from the liquid portfolio is right here, and that's for the first year only. It'll be inflated thereafter. Down here you see earnings assumptions for each of the buckets, and this is calculated based on the allocations that we indicated and based on the earnings assumption that we entered for each of the investment choices that reside in each of the buckets. So we have those 3 bucket return assumptions, and then this is a weighted portfolio average return right here based on the allocation that we have among all 3 buckets. Over here you see the current year indicated and the client's current age. Again, we're keying off of the younger person's age if we have 2 people. And this right here is, there's in the background of this model, there's a simple retirement calculation going on. There are obviously more sophisticated calculations, but the purpose of this one is just simply to look at the portfolio size, the portfolio weighted average return assumption, and what's our annual inflated withdrawal amount coming out of the portfolio. And given those factors and using a linear or a constant return assumption for the portfolio, how long would the money last? And that's indicated here. And this is just to give the user of the tool some insight as to how realistic the entries that they're making are, and will the money last through the client's life expectancy. As we go down to the buckets, look at bucket number 1. You'll see, you remember we indicated 1 year of income for bucket number 1, and that age and 1 year of income is shown out here to the left. And in the bucket, we're going to indicate the net present value of money needed in bucket number 1 to fund the income stream indicated to the left. In this case, 1 year, and we're using a lump sum beginning of year distribution assumption, so the net present value is equal to the $32,588. We have a 0.1% earnings assumption for the bucket, and the overall portfolio that resides in bucket number 1, or the percentage of the overall portfolio, is 4.35%. One other piece of information is that for this cash position, the dollar amount needed in that particular cash position is indicated for us as well. Bucket number 2, we'd indicated years 2 through 8 of income, and you see those inflated portfolio withdrawals indicated to the left here. Inside of bucket number 2, we see the net present value needed in this bucket using an earnings assumption of 3.5% to fund this payout for those years. The overall percentage of the portfolio that resides in bucket number 2 at this point in time is 29.26%. And here you see the dollar amounts needed in each of these investment line items, this first one and second one, currently. Bucket number 3, we'll see the next 10 years of income, inflated income indicated here to the left. And of course, this is not showing us all years of income. It's just showing us the next 10. As this states here, not all income years are visible currently. And this then is not the net present value of that cash flow, but this is just the balance of the portfolio in bucket number 3, invested at an 8.25% earnings assumption, and that equals 66.39% of the whole portfolio. And here's the amount of money of this $497,000 number that would be in each of the investment choices indicated here to the right. And down here at the bottom, we also see the money would be expected to last through what age. Okay, let's move to the last tab in the tool. The last tab in the tool is the Target Allocation Summary. What this page is going to do is it's going to take all the information that we've input on the previous tabs and the allocations that we indicated in each of the buckets and how much money needs to be in each of the buckets, and it's going to represent it as one large overall portfolio. So you'll see the bucket 1 contents listed here at the top, followed by bucket number 2 and bucket number 3. And it's listing the dollar amounts needed in each of the investments and the overall portfolio percentage needed in each in order to follow the allocation outlined in the bucket theory. Okay, let me just mention for a minute how I might use this tool. I think I would be inclined to perform this allocation process for someone at least annually. I'm looking for opportunities when bucket number 3 is performing well or at least moving sideways, and I'm going to recalculate the overall allocation of the portfolio and harvest from bucket number 3 as needed to reload buckets 1 and 2. The idea is to start each year, not necessarily at the beginning of the calendar year, but start sometime during the course of the year with all the buckets fully loaded. And so I'm postured and ready for a market downturn should it happen, so that I have the X number of years of income set aside in buckets 1 and 2, and the client is postured to endure a market decline and the waiting period that might be needed for the market to recover. Okay, let me comment on one other topic here that might be of help to you. I'm going to bring up another diagram here, and I'm going to call this the bucket strategy through an investor's lifetime. The bucket strategy tool that we've been covering is designed to address the retirement income distribution phase for an individual. But the question would come up, what leads up to that? And so here are a few thoughts that would outline my mindset surrounding how you lead up to that time frame. The initial phase, I guess, would be the accumulation phase. I would be inclined for young accumulators to have mostly a bucket 3 allocation through the accumulation phase. I would be setting dividends to reinvest during that period of time. It is likely that as a result of a suitability questionnaire process with an individual, more conservative investors may need some elements of bucket 2 during that phase, but I imagine that most people, particularly as young accumulators, would lean towards mostly a bucket 3 allocation. Then I'm going to move into a transition phase, and it's fairly subjective as to how long a period of time this takes. The primary objective is to have to fully load buckets 1, 2, and 3 during this phase so that we're fully ready at the beginning of the retirement income distribution phase to implement the bucket strategy. But during the transition phase, I would set dividends to pay to cash. I would change all of my contributions to the extent that I'm participating in a retirement program, and to the greatest extent possible within the confines of that program, I'm going to begin to make contributions similar to all the investments that I want to use in buckets 1, 2, and 3. The primary goal, again, is to fully load all 3 buckets in advance of the retirement income distribution phase. At the beginning of the retirement phase, of course, we're fully loaded. We're going to follow the allocation in the budget and in the bucket strategy tool. I'm going to set dividends to pay to cash in bucket number 3 as a mechanism to contribute towards the reloading of bucket number 1 on an ongoing basis. So that's basically the bucket strategy through an investor's lifetime. Now, one other thing I want to mention, the tool that we've been going over is a fairly economically priced tool. It's $150 as of the recording of this video. And we call it the Planning Templates Portfolio Income Distribution Tool, or the bucket strategy, as some might refer to it. And the website is planningtemplates.com. Once you approach the planningtemplates.com site, look for, under the Detail tab, look for Planning Templates Portfolio Income Distribution Tool. On that page, there's detailed handwritten notes about the strategy, about this tool and how it works. There's a PDF image that shows what the tool looks like with the information that was contained in this video as well. And there may be a few other things that might be pertinent there that might be of help to you. Thank you for listening, and please visit planningtemplates.com.